Hey traders, Raghee here, and in this free video we're going to recap a lot of the action from today. And the 2 points that I want everyone to be able to take away from this is, number one, as we go into May, just kind of a seasonal shift that I've made throughout my career is I typically just start to shorten my time frames. This is a habit that I had from the late 80s into the early 90s, where typically summertime trading just really was very low volume, tended to float around like a leaf on a breeze, and that changed into the early 2000s, and I think we've seen summer be a much more impactful time of year, especially if there's a trend through those summer months, up or down. Now, speaking of trends and what I used to do, which is shorten my time frame and really become more of a day trader between Memorial Day and Labor Day, sort of adjusted in the early 2000s. But again, if I had a trend on my side, it was a lot easier to be committed to longer term time frames through the summer months. The challenge is this now. If we see that this market is going to transition out of the uptrend that we've seen since, let's call it the Powell pivot, because that's exactly what it was back on Jan 4th, the Powell pivot. This market seems less run by the psychology of an accommodative U.S. central bank, and right now it's just full tilt because of the concerns about U.S. and China trade talks. Now, the market got a little bit of a reprieve when the president mentioned G20 could be somewhat productive, but this could be much more volatile as the market sees what the Chinese may do in terms of retaliatory tariffs, what the U.S. may do with the uncertainty about ratcheting up the next round of tariffs. I mean, it's just going to be back and forth. And so what's going to happen is if there's a good tweet or if there's a good headline out of China, the market's going to go up. And if we have sort of the kind of weekend we had this past weekend where the Secretary Mnuchin's words were basically flipped on their head going into Saturday, Sunday, where this idea of progress was then just squashed and the market sold off. I don't want to deal with this, right? Who does? The lack of a trend and clarity makes day-to-day follow-through darn near impossible. So what we do is we shorten the time frame. So what I'll be likely doing throughout the remainder of this week is watching for any kind of optimism off an oversold level to maybe drive us higher into the range, wherever that may be. And I'll probably go ahead and lighten up my longer term book. What do I mean by that? My longer term trading book. I have a number of daily time frame entries that are open in some key stocks as well as the S&P and the NASDAQ. All right. So even though we were day trading the Dow today, the neat thing about day trading is that it frees up the ability to just not care about what kind of follow through we may get after the trading day is done. We could wind the position down into 11:30. We can wind the position down into end of day. But by 4 p.m. Eastern, we're done. And then we start afresh, basically 9:30 again. And we look for the clearing range setups. We can look for breakout breakdowns. We can look for the initial balance setups to allow our runners to run. And then again at 4 p.m., we call it a day and start all over again. So that's kind of where I want to transition to on any kind of rally that we may see this week, on some sort of relief rally, or who knows, it's a tweet, it's some sort of kumbaya moment between the U.S. and China, which the equities markets seem to like. Maybe there's a shift in the tone from the Federal Reserve. Right now, Fed Fund futures, for those of you that do watch those, right now Fed Fund futures are pointing to a 50% chance of a cut, I believe, in September, like 65 in October. It just keeps going until we hit a 90% expectation for January of 2020. So, we go out to that Jan 2020 contract and we have a much higher expectation for a cut. And a cut trend on the Fed Fund futures is going to be continuing to move higher on the chart. So if we move higher on a Fed Fund futures chart, that is implementing a higher and higher percentage of the likelihood of a cut. So in the meanwhile, again, S&P and NAS definitely took it on the chin. Boeing and Apple certainly were kind kind of casualties of the heightened tension surrounding the whole trade talks. I do think there's a likelihood we could see an oversold buy and maybe we catapult back up into this range. But again, I want to really reduce my size, maybe get out of these positions and focus on day trading for much of summer. And really only be very, very choosy about these choppy markets we're now dealing with and engage the markets less in a trending way, which really is no longer valid, and engage in these oversold buys off these range extremes. So that's the transition that I'm looking to make into May. I'm not making this arbitrarily. I'm certainly not making it because of one down day, but I'm making it because we are seeing in chart after chart after chart, not just the stocks, but the stock indices and a number of commodities too. We're just seeing the market going into a much more distribution chop, which just takes away all the advantage of the trend that we've had through most of the year already, and we just kind of have to wait for overbought and oversold levels to get long and short. And that really does then free us up while we're waiting for the market to get to one end or the other of these ranges to look at 1 minute time frames, to look at 5 minute time frames and day trade. All right, so that's the update kicking off what I think is an important transition we're seeing here in mid-May, and I'll see you in the next update.